Hi students, my name is Chris. I'm an accounting tutor with Chegg Tutors. In today's tutorial, we're going to talk about static and flexible budgets. First, let's look at static budgets. A static budget or fixed budget is the original budget created by management based on a projected level of activity or output for a given period. The static budget pertains to one singular level of activity. And in analyzing results in a static budget, the variance is the difference between each line item in the original budget and the corresponding line items in the income statement. So for a sales variance, we would have actual sales minus the budgeted sales to give us our sales variance, either favorable or unfavorable. Similarly, for costs, we might look at the variable cost line item, taking actual variable costs minus the budgeted variable costs to give us the cost variance for variable expenses. So the static budget is very straightforward, but what we're going to look at next is the flexible budget, which is a tool used for improving cost control and performance measurement. The flexible budget is dynamic in nature versus the static budget. It compares actual costs for a given output level with budgeted costs for the same level of actual output. The flexible budget can't be prepared until the end of a period when you have the actual activity levels, so that you're able to adjust the static budget for that activity. The important thing to note about a flexible budget is that it utilizes the cost volume formula to create a series of budgets based on the various levels of activity. As a refresher, the cost volume formula is simply total cost that equals fixed costs plus variable cost per unit times the number of units. When looking at the variances in a flexible budget between actual and budgeted costs, you can then separate those variances into spending and volume causal factors to give a more detailed look at the results. The best way to illustrate this is take a look at an example of a flexible and static budget, comparing it to the actual results and computing the various variances. So here we have information for ABC Company for the year ended December 31st, 2015. We see that in the third column, the static budget. This was the original budget created by management for the year. You can see that they had budgeted an activity level of 12,000 units sold. Corresponding sales dollars with that were 36,000. And then we have the various expenses, materials, labor, variable overhead, variable selling, as well as fixed overhead and fixed expenses that produced a budgeted net income of $7,300. Now, looking at the actual results for this same period, the actuals actually came in at 10,000 unit sales, where sales volume was $30,000, and we incurred the following expenses. For direct materials, $11,200, direct labor, $8,500, variable overhead, $2,750, variable selling, $900, fixed overhead, $2,000, and other fixed expenses, $1,100, which produced a net income for the year of $3,550. When we compare that $3,550 to the static or original budget of $7,300, we see that we had an unfavorable variance in net income of $3,750, comprised of these various line items. Now, the question is, what caused the variances? As we can see, we were down in unit volume by 2,000 units. So obviously, right off the top, we have some type of volume variance. But what we want to look at as a management team is, how did we perform spending-wise given the lower level of activity? Were we able to control our variable costs in the same proportion that we had originally budgeted? So the first thing we need to do is create the flexible budget. And how that's done is simply starting with your static budget and looking at the variable costs per unit, and then computing those same costs given the actual level of activity. So in the static budget, we had $12,000 of material cost. On a per unit basis, since we were going to sell 12,000 units, that equals $1 of direct material per unit. And we do the same calculation for the other variable expenses. Labor, we divide 9,000 by 12,000 and get 75 cents per unit. Variable overhead, $3,000 divided by the 12,000 units, which gives us 25 cents per unit. And then finally, variable selling of $1,200 divided by the 12,000 units gives us 10 cents per unit. Obviously, fixed overhead and fixed expenses are fixed, so we're not going to compute any type of cost per unit for the fixed expenses. So now to compute our flexible budget, we're going to take those unit costs and apply them to our actual level of activity for 10,000 units. So remember, we said that labor was $1 per unit. And in applying that to the actual number of units, 10,000, that gives us $10,000 in direct materials as a flexible budgeted amount based on this activity level. We're going to do the same things with our labor, variable overhead, and variable selling, and that gives us the following numbers: $7,500 for labor, $2,500 for overhead, and $1,000 for selling. And as I mentioned, fixed overhead and fixed expenses, they remain constant or fixed, so we merely carry those over into the flexible budget column, which gives us a computed net income of $5,500 for this level of activity based on our budgeted per unit costs. So now we're going to create or compute the variances looking at the actuals versus the flexible budget. And what that gives us the ability to do is take the total variance versus the static budget and break it down into volume and spending. So let's look at sales as the first line item. Obviously, we sold 2,000 less units. Our sales on a per unit basis at $3 per unit were $6,000 lower. So that all relates to volume. Now, when we get into our costs, we're comparing $11,200 in actual direct material expense versus our original budget of $12,000. And what we see is a favorable variance of $800. But the question is, what gave rise to that variance? How much of it is attributable to the volume drop, and how much of it is attributable to better cost control? So to come up with the volume variance, we merely compare now the flexible budget, which we've adjusted for the new volume, to the original budget. And we can see that we spent $2,000 less in direct materials, which gives us a favorable volume variance of $2,000. Now for the spending portion, we compare the actual direct materials of $11,200 to our activity adjusted flexible budget, $10,000 for direct materials, and we see that we spent $1,200 more, which gives us a $1,200 unfavorable spending variance. Adding the two up gives us the $800 variance against the static budget. Let's look at direct labor. So the flexible budget said we should have spent only $7,500 in direct labor for this given actual volume of 10,000 units. Our original budget called for $9,000 in direct labor. So when comparing the flexible budget and the static budget, we have a favorable volume variance of $1,500. Next, we're going to compare the actual direct labor spending to what we should have spent given this activity level. And we can see that comparing the $8,500 in actual direct labor to the flexible budget of $7,500, we were unfavorable in direct labor by $1,000. The same pertains to variable overhead and variable selling. We take the flexible budget amounts, compare them to the static budget, to come up with our volume variance, which in both cases was favorable, $500 and $200 respectively. And then we compare our variable overhead and variable selling actual expense to the flexible budget. And we can see in this case that as far as variable overhead, we had an unfavorable variance of $250 in spending, but we were favorable in spending on our variable selling of $100. Next, we go into our fixed overhead and fixed expense variance analysis, which in this case is all spending. Remember that fixed expenses are constant, so we're comparing our actual level of spending, which should not change with the volume levels, to what our flexible and static budget said. And in this case, our fixed overhead, we were $500 favorable in spending, but our other fixed expenses were $100 more, which gave us an unfavorable spending variance. So looking at the bottom line, in comparing our actual net income of $3,550 to our static or original budget projected at $7,300, we were unfavorable by $3,750. But the causal factors for that are twofold. One, we had a decrease in volume, so we were unfavorable by $1,800. But our spending was also unfavorable of $1,950, which says to management that the variable costs, which are controllable, we were not able to align with the level of activity drop that we experienced versus our original static budget. So this gives you a look at the differences between the static and flexible budget, how to create the flexible budget, and then do your variance analysis and comparing your actuals versus budget and breaking the variance down between a volume and spending variance. If you have any questions or need more clarification regarding flexible and static budgets, my link on Chegg Tutors is here. Please feel free to contact me. Also, if you have any other questions or need help on accounting topics, don't hesitate to contact me. Thanks very much, and I look forward to speaking with you again on the next tutorial.